Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me at the MarketSite studio, we have Jason Greenblath. He's a Senior Portfolio Manager with American Century Investments. We're going to take a look at fixed income positioning for 2023. Jason, it's great to have you with us. Welcome to MarketSite.
Thanks so much.
How is American Century's fixed income team positioning their portfolios given high inflation, although slowing, in this kind of environment that we're in right now?
Sure. So we have to think about why is inflation slowing. Inflation's slowing because used car prices are coming down, big ticket items are coming down. Growth is slowing. So how do we position around a slowing economy, albeit with high inflation? What we think about is, one is interest rate risk. So we want to be short the front end of the curve because, as we've seen over the last 24 hours, the central banks are still raising rates and are concerned that they need to get inflation down and stay down. The second is growth. With growth slowing, we don't want to be too long credit risk. We know that there's a lot of money that's coming into fixed income. The valuations are really not justifying today taking that type of risk.
So with the risk of recession rising, how would a short duration strategy fit into an investor's overall strategy?
Sure. So I think what investors are getting today is yield. We didn't have that 12 months ago, and that certainly dampens some of the sensitivities around interest rates or inflation. So the appeal to going into a short duration strategy right now is you're not taking a lot of interest rate risk. Strategies like ours that have a lot of dry powder to take advantage of what could happen in the next 6 to 12 months with cheaper valuations is great, but the dampener is you can get a 6+% yield right now in the front end of the curve.
So what are some interesting yield-seeking opportunities that you've seen in the short-duration universe?
Sure. Over the last few months, the opportunities are predominantly in the securitized markets and in the investment-grade corporate markets. We've been shying away from high-yield bank loans and emerging markets. We just think that the risks there are too great and not worth taking. On the higher quality parts of the market, we're finding opportunities with 1 and 2 year maturities in securitized where we can get 6 to 7% yields backed by hard assets. In corporates, high quality single A rated bonds that are yielding 5.25%, 5.5%. And we think that's attractive.
Particularly with the short duration strategies, what are some of the opportunities and risks that investors should consider today in the near and intermediate term?
Short duration is going to be most impacted by what the Fed is doing. The front end of the curve is where the Fed has the most control right now. So we do need to be cognizant that that is a risk, that rates could come up a bit more. As I said before, though, the offset is that you have the interest rate and you have the coupon that's balancing some of that. So we need to think about the risk and reward there. I think some of the other risks that are in the market right now is that rates are higher and the Fed is in our minds going to pause, not pivot. That over time is going to erode companies' free cash flow. It's going to cause defaults to eventually rise. And I think that that's something that we need to be cognizant of, that it's not just money coming into the asset class because of yield. There are credit risks out there that we have to be worried about.
All right, Jason, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.